Hello, everybody. Welcome to Macro Money. This is Ilya Spivak, head of Global Macro here at tastylive. Welcome to the show. Another day and more macro data is back with us, helping to set the stage for next week's much anticipated Fed policy announcement on May 3rd. And today we are going to focus on inflation, our favorite subject here in recent years as we look at the Fed tightening cycle, and that really animates markets all over the world and across asset classes. What we're going to look at today in particular is going to be the March set of PCE inflation numbers. These are the Fed's favored numbers. Of course, the CPI is the most ubiquitous version of inflation measures, but the PCE one is the one that the Fed really prefers to set policy around. We're going to look at that and ask ourselves a very important question. Do the markets still like these numbers lower? Over the past week, there's been a bit of evolution over the past 2 weeks in this relationship. And of course, what we've seen over the past year is that, in fact, they do like them lower because that means fewer Fed rate hikes, maybe more Fed rate cuts. That's less of a hurdle rate on investment, less of a hurdle rate on consumption because it becomes easier for businesses and consumers to borrow and spend and invest, all of which would be considered good and has been encouraging for markets. Anytime inflation would tick lower, the markets would cheer. But is that still true? We're going to find out here, or at least lay out the evidence for why maybe there's something else going on here, and maybe we are needing to expect something else as we move forward and as the markets digest what actually comes out. Let's first consider the expectations. So this is the breakdown here. You can see for the month-on-month numbers, looking for a slowdown, for the year-on-year numbers at the headline, looking for a significant move lower from 5 to 4.1%. Not a big change in core, 4.6% seen holding, and a few other indicators here. The first quarter employment cost index seen moving higher. That was, of course, foreshadowed in the GDP numbers that we saw earlier. And the Chicago PMI number, that's essentially a leading version of PMI from Market News International, and they're looking at a bit of deceleration, but that's not something that's typically market moving. Really, it's that PCE set of figures that we're going to be focused on, especially with the Fed in the immediate view here, right on the horizon mid next week. So what do we have in the stage setting ahead of these numbers? Well, let's consider. We've been following how the expectation for inflation in markets has been evolving relative to realized numbers. The yellow bars there, the 2-year break-even rate, that's the bond market's priced in inflation expectation over 2 years. It's derived by taking the difference between nominal yields, which is what we typically look at when we say a XYZ bond is yielding ABC basis points or percentage points, and subtracting from that nominal yield the real yield, the TIPS yield, the one that's adjusted for inflation. When we take the difference between those yields, it's that inflation adjustment that gets us from nominal to real that comes out. And so that tells us what the market thinks inflation is going to be. That tends to lead CPI and PCE by about 2 months. And that makes sense, of course. There are lags in data gathering. These reports come out monthly with a lag, and the break-even rate is something that is trading in real time. And of course, markets are necessarily forward-looking. They anticipate the business cycle. They anticipate the economy. And so what we're looking at here then is an interesting set of circumstances where, on the one hand, we had that spike in February, which we haven't quite seen in the numbers yet, but we have since come in and actually looking very close to the Fed's target at 2.2%. So it's unclear that the markets necessarily would look at a weak number this go round, or a lower number. You can see the expectation there in the dashed line down to 4.1%, echoing the slide we saw in CPI, and essentially say, okay, maybe there's another spike next month, and so a pull down here isn't necessarily something to cheer, but also that spike to 3.2% happened when Fed rate hike odds were building to a 5.5% terminal rate. We thought we were going to have rates well above 5% next year because in February, U.S. economic data got really strong. But of course, since then, we've had the SVB-led banking crisis and a downturn in all manner of growth data. And so perhaps that spike is an outlier. And really, it's that near target rate that we're looking at now that makes sense. And so it would appear that things are progressing just as the Fed would anticipate them here. We see something similar when we look at the largest component of the U.S. economy, the service sector. The latest set of ISM numbers gives us a pricing component there. Of course, we know that this operates on the same system that you get from the PMI number series generally, which is that above 50 represents expansion, below 50 represents contraction. The further above 50, the faster the expansion, the further below 50, the faster the contraction. And what you see in the prices component for the service sector, again, this is about 3/4 of the U.S. economy here in the service sector. You're seeing it leads overall inflation numbers, again, core and core CPI and core PCE, by about 3 to 2 months, depending on which one you're looking at. For PCE, you see the lead is about a 2-month lead, and the pricing component here moving aggressively lower. Still in expansion territory, certainly, at 59.5 for the latest numbers, but pointing to significant deceleration. And of course, that would suggest that as with break-even rates, we are heading in the right direction. What the Fed is doing is working. We see something similar when we consider imported inflation. This is overall global trade volume, total exports plus total imports. You can see here, of course, the COVID bottoms for economic activity right there in the middle of 2020. Since then, a brisk recovery thanks to stimulus. And since the beginning of last year, a topping and a slide. And you can see that's been something that has been in line with inflation easing. So not really something there that's worrying. And again, giving the sense that if there were, for example, a strong pickup in demand from China around the reopening in December, we might see some inflationary pressure there. That's not what's showing up here. We're not seeing a big pull on commodities. We're not seeing a big pull on other demand externally that would translate into imported inflation for the U.S. So seemingly smooth sailing as well. This is more the quote-unquote transitory part of this equation. Let's go to the stickier part that the Fed really is very concerned about, and that's really been the animating force behind this entire rate hike cycle. Here's what's going on in the U.S. labor market. We still have a meaningful disconnect between labor supply, which is the current U.S. labor force, and labor demand, which is the number of people currently in work, plus the number of unfilled job openings out there. So essentially, what we're comparing is the number of people able to be working. The labor force includes people that are both employed and unemployed. It's just the unemployed have to be looking. But that's what we're considering our supply. The number of people that are working or could work and want to work. And demand is the number of people that are working plus the number of people that are desired to be working. And so you can see that the demand here still far outstrips supply. This, of course, is inflationary and has been inflationary because if these companies want to attract people and outbid others that want to attract the same people, given demand is outstripping supply, the only way to compete is on price, much as with any other good. And so this is upward pressure on wages, which is then upward pressure on inflation, because if there's upward pressure on wages, well, then everything ends up being more expensive to do and make. So interesting dynamic here is in the past month of data here, it seems like demand has actually ticked lower a bit. Now, it's still very preliminary. We've seen ticks like this earlier, and they didn't really translate into a whole lot. So the way to look at this is to put it all together with CPI. So I've taken the difference between supply and demand and made it into these gray and blue bars that you're seeing here. And you can see, I think, relatively readily that as the mismatch between labor supply and demand starts to shift along the recovery with COVID, or from COVID, I should say, in the economy, and you start to see supply first shrink relative to demand, you start to see inflation come up. And then, of course, now we're looking at a situation where demand significantly outstrips supply. So the bars there, the blue ones, are below zero. What you see here is that so far, this has not stopped inflation from falling. So the Fed's efforts still, although this mismatch has been fairly steady, the Fed's efforts have been successful so far at cooling inflation. Now, this mismatch probably means that there's a degree of inflation that doesn't get squeezed out. And so the question becomes, is what the Fed doing enough to take us to 2%? Because, of course, before COVID, inflation was quite weak. And the Fed, for a decade and change, was struggling to get to 2% as something of a sustainable level of inflation. So given this mismatch now, we're maybe looking at inflation that stabilizes at 3, maybe looking at inflation that stabilizes at 2, if nothing else changes, of course. But what we can see very clearly is that what this mismatch is not doing is preventing us from taking inflation down from around 9 on CPI and around 7 on PCE and coming into 5 and 4 respectively. So far, there is still inflation to squeeze out, it seems, before this establishes a floor on it. So again, so far, so good. Looking at the yield curve, we can see that over the past week, it is basically motionless. It's certainly become more flat since the SVB episode squeezed out those now seemingly excess rate hike expectations in the wake of strong U.S. data in the front part of February. And you can see here a very familiar story that we've seen now for the better part of a month. Rates seen peaking just in that mid-5 range. So the peak now around 5, 5.1, 5.2, which of course puts us right in the middle of the 5 to 5.25 range that we're expected to reach here with one more hike. And then we start seeing cuts. So within 6 months from here, we are back into the current setting, 475 to 5. Within a year, we're at 4%. Within 2 years, we're at 3%. And that seems to be where we sort of hang out for the near term. That's pretty much in line with what the Fed has been anticipating as the long-term rate. So as we're looking at this, it seems to be that the market is fairly comfortable. It's seeing inflation come in. It's seeing the various sources that we just looked at, both domestic, international, sticky versus transitory. All of those things seem to look fairly benign. And so the question is, well, okay, so if we get a number that's in line with expectations, is there anything for the markets to celebrate there? Considering they appear to be pretty well priced for exactly what's going on. There's not a whole lot here that would change if you got a number on the PCE reading that comes in from 5 to 4.1. It would be broadly as expected, in line with all of the various dynamics that we're watching here, none of which really scream anything nefarious or troubling is occurring here. So if we get a lower number, does the market actually cheer that? Do we rally? Well, if there's not really anything else to reprice, perhaps not. And indeed, it doesn't seem like there is. Looking at Fed policy expectations, we get a 90% chance of a rate hike next week. 23 basis points of the 25 are already priced in. We can see that by June, 29 basis points are priced in. So there's a very, very slight 16% chance that we get a further hike. But it's so minuscule that, frankly, you would need a significant change in the incoming economic data, in my mind, to really cement that in. It seems like we are at a setting here whereby the market is pretty well anchored to there being a peak in rates after next week's hike. Looking then out along the expectations table here, you can see that come November, you're flirting with the possibility of a cut. There is perhaps a slightly better than even chance of one by then at 78%. It starts to strengthen by December, where that one cut is already baked in, and there's maybe the possibility of a further one. And of course, it's a bit low here at 16%, but come January, that cut's there. And so by January, we've come in by 50 basis points relative to where we are now. So if we were to get a number here that's relatively weaker, would that change this? Probably not. Not in a very significant way. Maybe we'll get a slightly stronger chance of more cutting in December. But is that something that cheers the markets at this point? Well, it doesn't seem like it really would, considering there's not much to see. There's not really much to alter the forecast. So why should we care? Well, this, of course, is the key consideration. The reason we should care is because the fundamental dynamics of what's going on here may well have changed precisely because the markets have priced in this part of the story and moved on. As ever, the markets are always searching for what will drive things next. They are ever forward-looking. And so what we consider here then is the evolution in the Citi Economic Surprise Index, which since the the run-up in February, you can see that readily here. This was that run-up in U.S. economic data that gave us those heady expectations for policy before SVB and company spoiled the party. Since then, we've actually seen a turn in the data. So economic data seemingly is actually doing worse at this point relative to expectations. It's not tending toward underperformance. We're still above zero by a narrow margin, suggesting that data has still retained the tendency to surprise higher on balance as compared to lower. But the margins have contracted significantly. And of course, markets don't care about absolute readings. They care about relative direction of travel on indicators. So what we're looking at here is U.S. news flow that's been deteriorating relative to what is being pumped out by economists' models. This is the expectations that you typically see quoted by Bloomberg, by Reuters, which they come up with by a poll of a whole slew of industry economists that they then establish a median out of and say, okay, the median expectation is this. Against those expectations, it looks like analysts' models are pointing to a rosier economy than what we're seeing. And this, of course, represents a significant risk, because if this means that what we get is a PCE number that's weaker than expected, the results may not be what we might have expected even 2 months ago. The story has been, really since the beginning of last year, and perhaps even a bit before then, the Fed really started to telegraph this rate hike cycle in the middle of 2021, and the dynamics that implied have already started to essentially make themselves evident by the beginning of last year. What we're seeing is maybe a change. Over the course of the past year, if some sort of economic data came out that caused inflation expectations to come in, and with them rate hike expectations, the markets cheered, as we noted earlier. Well, that might not be the way things work anymore. And a downside surprise might have very different consequences. Consider what's been going on here recently. This is the path expected for Fed rates as implied in Fed funds futures. That's the December contract. So looking at the end of this year there in the red line. The yellow bars are the S&P 500, and the dashed line there is just a 5-day moving average to give us a better sense of direction in those bars. Note here that over the past week and a half, stocks and the Fed rate hike outlook, or the Fed policy outlook, net of hikes and cuts, have been trending lower in tandem. This is not the kind of thing that we saw earlier. Look at the beginning of the year. You see that as you get the run-up in Fed rate hike odds here, that, of course, exactly the February situation that we see here. So this run-up in the economic data giving us this run-up in Fed policy expectations. This is met with a decline in stocks. Then, of course, you get SVB, Fed rate hike odds collapse, but stocks continue going lower because we're flirting with credit crisis risk. As you get to the rebuild here in risk measures, because ostensibly the containment efforts of the credit crisis are working, Fed rate hike odds recover some, and you can see these things are starting to move together. And it seems to be holding up on the way down. So the overall direction of travel here seems to have lined up. That is not the kind of thing where you would say, oh, well, if the inflation number is weaker and Fed rate hike odds decline, Fed rate cut odds increase, that risk is going to necessarily celebrate. On the contrary, it seems like the market is increasingly reading that kind of thing as a sign of cooling demand and inflation risk being the secondary concern, and recession risk being the front of mind concern. You see something similar in the behavior of the US dollar. Again, take a look here and you see here's that good economic data in February giving us the run-up in policy expectations. That's being met with a stronger dollar. As you get the collapse from SVB and the subsequent recovery, though, the relationship changes. So you can see, even as Fed policy expectations rebuild, the dollar is weakening. Weakening at the same time that stocks strengthen. This is that risk on-off dynamic that the dollar often displays when it moves not as something bolstered by yields, but as something that is bolstered by haven demand, as the unrivaled, unmatched global currency of transaction. Nothing is more liquid than the US dollar, and all the recent talk of its displacement as the transactional currency of choice, to my mind, is frankly nonsensical, because there's simply no alternative. And so when we look at what's going on here, we can readily see it in markets. As risk deteriorates, you can see the dollar actually holds up. It doesn't collapse during the SVB episode. It starts to actually go down later into the mending as risk comes up. And just as now you see with risk rolling over, Fed policy odds are rolling over in tandem, so too you can see the dollar is gaining as Fed policy odds roll over. That is not the story of a currency that's looking to higher yields to give it a greater appeal. That is the story of a currency that's deriving its appeal from weakness and consternation. So if you ended up with a weak PCE number, as the flow of recent data seems to flag could be the risk, and if a mildly weaker number isn't something the markets are going to celebrate because everything is priced in and things are moving on the trajectory that you might have expected, then really the outsized risk here is that you are going to get a significantly weaker number, and that is actually going to be looked at as a barometer of incoming recession and hurt risk as opposed to help it, but help the US dollar as opposed to hurt it. And that is macro money for today. Thank you very much for joining me. As ever, I am here Monday through Thursday, right after Overtime, which is a show I do with our friend Chris Vecchio, head of Futures and Forex here at tastylive. I am then on with Chris again and will be tomorrow for Futures Power Hour on Fridays, and back with Tom and Tony for First Call on Sundays, but for this coming Sunday where Chris will sub in, I'll be back in the subsequent week. Outside of the shows, you can always catch me opining on Twitter at Ilya Spivak. Thank you very much for joining, everyone. That's Macro Money for this week. I'll see you for Futures Power Hour tomorrow. Happy trading out there. Good luck. Speak to you soon. Take care.